Good day, Tea with Travis. Today is July 10th, Friday, and a great week for mortgage bonds. For several weeks we were in a sideways trading pattern, and the rates really weren't improving or worsening, but this week we finally busted through some ceilings of resistance and saw quite an improvement in pricing and rates for mortgage bonds. The stocks haven't fared so well this week. There's been some economic reports have come out. Second quarter earnings have come out pretty dismal for some companies. They should really hit the market next week with these numbers. But oil prices are down again. Wednesday was the largest one-day drop in 3 months for oil. It's back under $60 a barrel. Today, consumer confidence numbers came out on the Michigan report, and it was worse than expected too. For basically, it's the level of confidence we have as citizens and consumers in the market, in the financial markets and things, and it was lower than they expected. So all those things line up for bad stock numbers, or people are leery of investing when these numbers are coming out like they are. But the good news is money rolls back into bonds or mortgage-backed securities. Like I said, we went through some layers of resistance, and now they've become layers of support. That's going to take some big financial reports to cause mortgage rates to worsen. But we do have some technical factors that may cause mortgage rates to stay here. I think we might be capped off for a while. We have several things that are happening. The Treasury continues to flood the market with Treasury note auctions and bond auctions for long-term notes. And with this flood of money coming out into the market on a global economy, after a while, it loses steam and loses interest in our bonds and things. We had a really powerful 10-year Treasury note auction on Wednesday that caused the market to really rally. But then the 30-year bond auction yesterday didn't go very well. So it's kind of a mixed bag of numbers there. But also bonds are considered to be in an overbought state. And what that means is that on a stochastic crossover chart, it's basically a chart that they gauge trading of mortgage bonds. They're just like stocks and the value of them. And when they become an overbought state at the top of the chart, usually there's a decline or worsening in price in the coming weeks. It's pretty much like clockwork. So we have a few technical factors that would support mortgage bonds at least not improving and possibly even getting worse. So if you've been on the fence, I think we're getting down to a point now where it would make a lot of sense to pull the trigger again if you hadn't got back in on it back when it was in the upper 4% range. The other thing to consider right now too is if you're considering to sell your home in the next 5 years, or even purchasing now and it's a starter home or a home you won't keep more than 5 years, it really makes a lot of sense to consider an adjustable rate mortgage. And I know the media is giving them a lot of bad press, but the reality is if it's a conforming loan and it's not a subprime, which they're not even available anymore, you can get a really good rate. I mean, you can get 3.75 with an APR just under 4 on a 5-year mortgage, 5-year ARM, adjustable rate mortgage. So it's fixed for 5 years at 3.75, that APR, like I said, below 4. And with that, if you compare that to, like, let's say a 5% 30-year fix right now, that's a 1.25% savings on a loan amount. So 1.25% savings on, let's say, a $300,000 loan, in that difference in a monthly payment is $312 in interest saved. Go by the year, it's $3,700 or $3,750. And if you look at a 5-year window, if you were to get a 5% mortgage versus a 3.75, you're saving $18,750 in interest. Before taxes, tax equations fixed into it. So that's a big number. So there's really no reason to get a 30-year fixed mortgage if you don't intend to keep in the home more than 5 years. You're just basically over-insuring yourself for a fixed rate that's not real effective. 30-year mortgages are great, but you have to think about it. Just think back in your let's say the last few homes you've owned or last few mortgages you've had. How long have you had them? And I have a lot of people balk at the idea of having an adjustable rate mortgage that's fixed for 5 years, but then I look at their credit report and they've had 7 mortgages in the last 15 years. So you do the numbers, it's about every 4 or 5 years people are refinancing anyway for various reasons, whether it's equity management, rate change, buying different homes, investment opportunities, college savings for the kids. So there's all kinds of reasons why you may not have that mortgage for 30 years. So I think just ask yourself that question. But with that, it's looking good again. The rates are looking good. Home values continue to level off and even drop a little bit more. And so if you haven't bought yet, I would definitely think about it. And investment properties are a wonderful investment right now too. So I look forward to serving you. Tune in to Neliton.com, Neliton.com for more updates. And we look forward to serving you. Thanks.